Hello everyone. Today I will talk about the impact of FinTech on the profitability of traditional banks. This paper studied the impact of FinTech on the profitability of traditional banks. Internet finance began to develop rapidly since 2012. It mainly focused on online banking, P2P platforms, crowdfunding, third-party payment, and wealth management products. Non-bank payment institutions processed 827.297 RMB billion online payment transactions, with an amount of 294.56 RMB trillion in 2020, an increase of the percentage of 50.9 and the percentage of 17.88, respectively, compared with 2019. The net profit of the banking industry declined rapidly, and the growth rate dropped from the percentage of 39 to the percentage of 2.39 from 2011 to 2015. The overall investment of traditional banks increased investment in financial technology from 2018 to 2020. Banking industry invested 100.8 RMB billion in financial technology, accounting for more than the percentage of 2 of operating income in 2019. It invested 207.8 RMB billion in 2020, an increase of the percentage of 15 compared with 2019. The first subject is the definition of FinTech. It integrates big data technology, AI, blockchain, and cloud computer technology. It is the use of technology in the financial market for products, service, technology applications, and business model. It uses the network to select and match users, which effectively improves efficiency. The second subject is the effect of FinTech on the traditional service model for conventional banks. FinTech companies distribute more suitable and extreme service to customers than commercial banks. The interest rate of demand deposits in internet finance is higher than the interest rate of fixed deposits of banks. The operating model of internet finance can effectively reduce input costs and maximize benefits, which is a challenge to the traditional financial industry. Internet finance can effectively reduce information asymmetry and transaction risks. The third subjective is that FinTech promotes innovation and development of traditional banks. FinTech not only helps traditional banks reduce operating costs, but also improves business processing efficiency. It also helps to improve customer satisfaction and enhance market competitiveness. FinTech provides technical support for traditional banks, which can cut down the unbalanced needs and shorten throughs for traditional banks. The methodology is quantitative analysis. Use random model to study the influence of FinTech on the revenue of traditional banks in China. This article analyzed the data of 10 traditional banks in China from 2012 to 2019. It selected the commercial bank's return on equity as the variable and the capital adequacy ratio, non-performing loan ratio, cost-to-income ratio, non-interest income ratio, GDP growth rate, and M2 growth of commercial bank, and control variables. In the table 1, it is descriptive statistics of variable. It shows that the replacement ratio of e-banking had changed significantly. The average CAR was 0.124539. The lowest figure is 0.1028. Therefore, traditional banks keep a comparatively elevated capital adequacy ratio, which weaken the capital risks and increase capital costs. In the table 2, it is correlation analysis. The table indicated that the rectification between GDP and NPL, M2, and non-interest income ratio were all greater than 0.5. As a result, it is necessary to exclude the GDP variable and perform regression analysis on the remaining variable. In the table 3, it is a stationarity test. LLC test was used to obtain the statistic and p-value of each variable, which can check the motionless of the fingers. The p-value of each variable is less than 0.05, and there was no unit root in the time data, which is stable. In the table 4, inside data impression model regression analysis, the data results are significant, and the percentage of 10, the percentage of 5, and the percentage of 1 respectively. It can be seen from the incidental impression model that R squared is equal to 0.8198, while the is equal to 431.7, and the p-value is 0, which means that the random effect model is reasonable. Table 5 is robustness test. The value of R squared is 0.6657. The model fits well. The FinTech and the return on assets have a significant positive correlation. The rigorous outcome of non-performation ratio and the cost-to-income ratio are impressive, and they are pessimistic on the return on net assets. So, FinTech had considerable beneficial consequences on the ROE. Traditional banks should strengthen investment in the FinTech field, instruct more professionals, and embellish financial technology management. As the exponential scale of M2 increases, the amount of capital in the market increases, and the scale of commercial bank assets expands, which improve revenue. The greater CAR will cut down the gains of traditional banks. The growth in the non-performing loan ratio will weaken the revenue of traditional banks. The excess the cost-to-income ratio, the greater the bank's cost per unit of revenue, and the lower the profitability of traditional banks. The discussion. The first is combination of traditional banks and big data. Traditional banks should integrate information resources and analyze data to make strategic decisions and risk control. The second is combination of traditional banks and blockchain technology. Blockchain promotes the application of electronic money, which will help track and record currency transactions and improve the efficiency of capital operations. The third is combination of traditional banks and artificial intelligence. Traditional banks use artificial intelligence in language recognition, natural language processing, image recognition, and IT vision technology. The fourth is combination of traditional banks and cloud computing. The bank headquarters can concentrate manage the development business of branches, online platforms, substitution, and overseas to improve processing efficiency. Okay, thank you.